From today, that is 15 December 2024, you will be able to purchase a bigger house with a less down payment, and you are also able to increase your amortization over 25 years. On surface, this sounds like a really good news for first-time home buyers, but today we will also discuss the negative aspect of it. If you are making a move in 2025, you need to know about these new mortgage changes so you can know how it will impact you and your buying decisions based on the new mortgage rules. And if you're a seller, you need to know about this, how your home buyers will be affected so you can strategize based on it. These new changes will be in effect today, that is 15th December 2024. Hello everyone, my name is Parth Soni. I'm a realtor based in Waterloo region, helping families and investors to make a move in Toronto and Waterloo region. If you find any value out of this video, the only thing I ask is to like and subscribe to my channel. So in today's video, we will cover following things. The very first one is what is changing, what are the new rules. The second thing we will cover is how it will impact first-time home buyers, that will be you, with some real life scenarios. The third is the market impact with these changes. So let's see what is changing from 15th December. The very first change is raising the insured mortgage price cap from $1 million to $1.5 million. So to give you a little bit idea about this, previously, if you want to purchase a house over $1 million, you need to have a minimum of 20% down payment. Now that $1 million has increased to $1.5 million. So anywhere house lower than $1.5 million, you can eligible for less than 20% down payment based on the new changes. The second change is making 30-year mortgage term available to all first-time home buyers and anyone purchasing a new built homes. Before this, regardless of the new or older house, 25 years the maximum amortization you can get from your bank. And just to give you an idea, before 2012, we used to have 30-year amortization, and even before that, we used to have 35 and 40-year amortization. Now, here is a quick snippet of a 30-year versus 25-year amortization back in 2012. Now, this will reduce your monthly mortgage amount, and this will help definitely few families out there. But is it really that helpful? Let's check. Now let's see how it will impact first-time home buyers. This is a really nice change for quite a good amount of families out there who are living in major cities where housing is very expensive, like Toronto and Vancouver. It may not be necessarily impact all the first-time home buyers, but cities like this will definitely see few results out there. Now let's take a quick look of a down payment requirement before and after. So here is the change number one, that is the raising the insured mortgage cap from $1 million to $1.5 million. If you see on 15th December, before 15th December, for a $1 million house, you need to have a minimum of 20% down payment, that is $200,000. And after 15th December, the down payment requirement changes to minimum at $75,000. That is a $125,000 difference. Same thing goes up to $1.5 million. If you are someone who's purchasing $1.2 million, previously it was $240,000 down payment, now it's $95,000. And if we go all the way to 1.499999, previously, the down payment requirement was $300,000. Now it's only $125,000. It's a whopping $175,000 difference. So if someone who is having less amount of money as of right now, they can still able to purchase $1.5 million home. Now let's take a real life example. If someone who's looking for a 3-bedroom double car garage home in a really nice neighborhood, but because of the down payment requirement, they are restricted to triple nine amount because they don't have 20% down payment. Now, with the new rule, they don't need a 20% down payment until $1.5 million home. So, what essentially this could do for that family is that they can have their lifestyle like what they are looking for initially, like a 3-bedroom double car garage in a better neighborhood at 1.1 or 1.2 million price point. Because of that down payment requirement, they were able to increase that purchase price. So instead of compromising their lifestyle with a house that they can have under $1 million, which they can spend 5 to 7 years living down there, they can have a better house at 1.2 or $1.3 million where they can stay at 15 to 20 years. Now, in this case, it's a really win-win solution for them. And just a disclaimer, it's not only about down payment. Previously, also they were able to afford their mortgage. Basically, even if they go for 1.1 or $1.2 million house, the only thing restricted them is the down. So before getting into those kind of agreements, make sure you are able to afford the house that you are planning to buy. And to be honest, not many first-time home buyers are looking for a house that is higher than $1 million, but there are few more. Now, for the same example, let's take what could be the negative aspect of this in the industry. So this will definitely increase the competition of the houses between $1 million to $1.49 million. and we could see a price increase in that particular category, which is already inflated or a higher prices. So far, I know three of my clients who have to restrict themselves under $1 million because of only down payment issue. On paper, they are easily able to afford 1.1 to 1.2 million house based on the monthly mortgage. Just because of the down payment, they have to go under $1 million. Now let's talk a little bit about the 30-year amortization and how that could be a positive and negative situation both. So let's take a quick example for that. It's an example of a couple. Out of that, one spouse is working towards a certification or something through which they were able to increase their salary, their income so much high that they are able to afford that house in a much shorter duration. But at present, they are not able to afford that house that much, so they have to stick under a budget. In this kind of scenario, it may be helpful to get a 30-year amortization where, as of right now, you enter into a housing market if you really want to, that you are not able to afford. So you can stretch your amortization from 25 to 30 years so your monthly payment decreases. And once you have that certification, provided your salary increase, and you can put that extra amount of money which you are getting from your salary towards the house. Now, the negative aspect of this example would be when you are switching from 25 to 30 year, or regardless of any sort of mortgage, when you are going for a higher term, more amount of money goes towards your interest rather than principal. So just make sure, educate yourself. You are making an educated decision after running all the numbers. So let's take an example. Here's the one of all the purchase price. Let's say from 500,000 to 1.499 triple line house. If you see, there is a difference between 25-year amortization and 30-year amortization. And so for a $500,000 house, if you go for a 25-year versus 30-year, you will end up paying $84,900 more just for switching from 25 to 30 year. And if you see over a period of 1.4 triple line house, that is almost 1.5 million house, you will end up paying $245,000 more. If you want, just take a quick screenshot. Here's all the purchase price. And if you're looking for a calculator like this, shoot me a text or shoot me an email. I'll have it. And here is also another example of the monthly mortgage payment that you will be making in 25 years versus 30-year amortization. So for a $500,000 house, the difference is roughly about $227. Now, provided you have 5% interest rate and all other things matches up. So just make sure with your mortgage agent what will be the difference between 25 year and 30 years so you can act accordingly. Now let's check out what will be the market impact and my thoughts about it. So very first thing that came into my mind after hearing about 30-year amortization on a new built house is like government is pressurized in some sort of a way to introduce a new policy that could help developer to get out of the mess they are in, right? If you know, new home sales are historically low, and there are portion of it that goes when a purchaser buy a new home, portion of it goes towards the government, and as the sales goes down, that portion is not going to the government. And I think this might be the reason they are coming up with this new policies which could attract more buyers to go over towards the new house. And this will also definitely help out developers to sell out their inventory. But be a smart buyer and check actually makes sense for you to purchase under 30-year amortization or not. I'm much more interested in seeing a price point, how that will play out in a early spring of 2025 for a house price that is between actual market value, actually between $1 million and $1.5 million. If you are a seller and your house falls under this category, it will be really beneficial to you because your buyer pool is definitely increased. And if you're a buyer in this category, make sure you run your numbers properly, work with a realtor who knows what's happening into the market and act accordingly. Now, if you want to chat about your particular situation or anything about real estate, feel free to book a call. That will be the first link in the subscribe and like for more real estate insights like this. I will see you next time. Thank you so much for watching.